So can you tell me how you find your daily bias when you open a chart? And ideally in a nutshell. Odds are that you can't. Or it's a long list with too many rules and too many things to pay attention to that you don't actually end up using. Again, we've all been there. And that's exactly why I'm here to help you. Now, I've realized, you might also have it, that the older I get, the more I realize how nice it actually is to have a manual when you buy a new product. There's no messing around. You just know exactly what to do. That for me is the exact same in trading. So you also need a manual for your daily buys. And you're going to learn that manual in 4 pieces. Piece number 1 is about understanding the accurate representation of what a daily bias actually is. Now, before we dive into that, I need you to understand the following. We have helped many traders with this exact same problem. I mainly trade for investors. I like to take these concepts and test them on funded accounts, which is exactly what I'm doing here. This is a funded account where I just, again, like to test these concepts with something real on the line, which is where I can now claim a new payout as well. Point I'm trying to make, me getting to eventually trade for investors and getting to payouts right there just for testing's sake. And also the MMT students that achieve the same thing, it wasn't easy. So this video is purely for traders who are serious about building a process. It's not a quick shortcut or a hack or anything like that. And if you are looking for that quick shortcut, then this video won't make sense to you. So will it be easy? No, and it shouldn't be. But will it work? Yes, absolutely. We first need to understand an accurate representation of what the daily bias actually is. Because you might have a false belief of what it actually means to have a daily bias and what trading in general means as well. Trading is really about picking your poison. So in order to get to an edge, you need to sacrifice something else, if that makes sense. You can't profit from everything because profiting from everything leads to profiting from nothing. So an accurate representation of what a daily bias actually is if we take a look at this text right here, we have a lot of dashes right here. And then after a few dashes, we get a bar. And then after the bar, we get a lot of dashes again and another bar. Maybe a few more dashes and another bar. Now these dashes, they represent when it's uncertain, when we are essentially waiting in our daily buys. And these bars is when it's so obvious that we can easily profit from it. And when those bars happen, that's exactly the moment we want to act on it. Now, the reason why this is important to understand is to go into this with the right mindset, because we have two different types of biases actually. Now there's one higher time frame bias that is relatively always going to be somewhat clear, but the daily bias, the short-term bias, is not going to be clear every single day. But what is going to be clear by the end of this video is exactly what you are waiting for. So in those brief moments where the daily bias does become obvious, you can profit from it. Again, the doom cycle in trading is the following, where if you know you should capitalize on a certain move, but you can only see the move happen in hindsight. So after the move has already happened, now you're sitting there like, oh, I should have profited from that. And the reason why you can't be consistent in catching those moves is because you have no idea what you are consistently waiting for. So if you don't know what is consistently expected from you, it's very hard to consistently capitalize from the same move over and over and over. So I mentioned that we have two different biases. At this moment in time, we are looking at ES. And the reason why we're looking at ES is because by the time you're watching this, most likely there's already a video online on this channel that has something to do with trading all-time high instruments. And at the end of that video, I outline exactly what I'm waiting for on ES right here in order to get involved, in order to have a clear bias again. Now, the reason why I'm saying that is because I have clarity. I know exactly what I'm waiting for. And it played out quite nicely. Now, this video here is not only about all-time high instruments, because this can be applied to anything that you can trade. The first type of bias that we have is quite easy, quite straightforward. It's the higher time frame bias. The higher time frame bias is usually not really a problem. So it might not be a problem that you have, because the higher time frame bias, for example, on ES is, well, I could argue that my nephew of 2 years old could also accurately say what the bias is here. It's probably to move higher, right? And the way we determine that is through, for example, order flow, fair value gaps, market structure. It's simply looking what have we already been doing on these time frames. So what we see on ES, we have already been continuing higher. Okay, so can we continue in that same direction? Can we keep continuing higher? And that is very similar to Forex. So if we take a look at Australian dollar, US dollar, recently in the short term, we have been continuing higher. So if we have been continuing higher, can we continue in that same direction? So can we remain bullish right here? And then that becomes our higher time frame bias. Now, the reason why this is important to understand is because now we can move on to piece number 2, which is that daily bias. We always want our daily bias to be in alignment with the higher time frame bias. So if we take a look at ES again, if we determine that the higher time frame bias right here at this moment in time is bullish, then we are going to look for a daily bias that is also bullish. Why do we do this? Because this is the highest probability thing to do. So can you, if the higher time frame bias is bullish, can you take a look at shorts? So a bearish daily bias? Yes, can happen for sure. But I need you to understand that there is going to be lower probability, which simply means you're going to take more losses than if they are in alignment with each other. Now, a clear daily bias is very straightforward. It's 2 methods that we can use. So number 1, a clear daily bias is what are we rejecting from? The second method is my personal favorite. It's what is preventing us from continuing higher, or in a bearish bias, bearish high time frame bias, what is preventing us from continuing lower? Again, we are going to look at a higher time frame bias bullish. So all the daily bias is going to be in context of moving higher. Now, both these methods, both these options, they come down to one thing. And this is the most important thing to understand, because you're always going to be trading in between PD arrays. A clear daily bias is when we move from one PD array to the next PD array. And in between moving from one PD array to the other PD array, that's where price is free to move. So that's where price moves fast, where it's very easy to manage to get involved. Now, why this is, again, all things we're going to break down. I first need you to understand as well that it comes down to which PD array are we likely reaching for next. And the way we can understand that is by understanding respect and disrespect. So which PD arrays we have been respecting and which ones we have been disrespecting. Based on that, we can understand which PD array we might reach for next. And before we dive fully into the respecting and disrespecting, we first need to understand what does it actually mean to trade in between PD arrays. Again, the whole story right here is about PD arrays. So daily bias a lot is also about PD arrays. Now we're going to narrow down our focus. We're just going to focus on fair value gaps and swing points. So swing highs and swing lows. And the reason why these PD arrays are quite important to understand is because in price, what we see very often is that we continue higher, but we also continue lower because of these PD arrays. So for example, we have this swing high right there. That swing high causes us to move lower. We also have this swing low right there. That swing low is what we sweep, we respect it to then continue higher. Then we have this fair value gap right there. That fair value gap is what we trade back into to continue higher again. So when price moves lower, it's oftentimes because of a PD array. When price moves higher, it's also oftentimes because of a PD array. Now, why is this so important to understand? Is because when we have this fair value gap right there, we understand that fair value gap, the bearish fair value gap, is a PD array. So that PD array is what we can potentially trade back into, like we see right here, to then continue lower from it. Now, what we just explained, that would also mean that if we are not going to continue lower from this fair value gap, then what is the next PD array that we might want to continue lower from? Well, it's this swing high right here. And that is exactly where we're now starting to talk about trading in between PD arrays. Because if it's not this fair value gap that we are going to push lower from, something like this, well, then it's going to be this swing high right there to potentially continue lower from. If it's not then swing high, well, then we might reach for something higher to then continue lower from it. Now, can you see what we're doing right now? Because if it's not the fair value gap, and the moment we disrespect the fair value gap, that's when we are allowed to move higher. We can freely move towards the next swing high. This green area right here. And why is that the case? That is the case because there is no PD array in between. So what we see right here, the moment we sting back into that fair value gap, the fair value gap has been used up right now. Again, and you need to understand, no 50% level, no 75% level, no inverse fair value gaps or anything like that. No. If you want to remain your accuracy, then do what I do, essentially. The moment we disrespect this fair value gap right here, there is no other PD array that we can continue lower from right here. It's just this next swing high. So it's very high probability that we are going to now reach for the next swing high right here. So the green area essentially indicates that there's a short-term opportunity right here. A short-term area where it's very clear that we are going to reach for the next target. That is exactly what I mean with trading in between these PD arrays. Now let's move on to the next piece, which is respect and disrespect. We're going to go over more examples to fully make this clear, because this is only the start. Again, we have these two methods. So there's two methods of having a clear daily bias. The first method was, what are we rejecting from? Now, what are we rejecting from? If we first understand that the higher time frame bias that we're looking at right here is again bullish. So if we start marking out these swing lows and also these fair value gaps right here, then we'll start seeing a certain story. Because what we see right here is that we are respecting one PDA. And because we are respecting one PDA, this allows us to move towards a next PDA right here. So this green area in between the moment we respect this PDA towards the next PDA, that is where, again, price is allowed to move freely, because we are, again, trading in between PDAs. Now, the same goes for this example right here, where we have this fair value gap. The moment we respect that fair value gap, now price is allowed to move freely towards this next PDA, which is that swing high. So this green area, again, is another area of opportunity. Now, if this is not the first video that you are watching on this channel, you might already be quite familiar with this. This is also what we call usual context. Now, the second method is my absolute favorite, because that is about, again, what is preventing us from continuing higher. And I really want you to think about this, because a lot of people, they tend to get obsessed. For example, that we have a daily fair value gap right here that we might want to retrace back into to then continue higher from. But why do we not retrace back into it? Why do we already continue higher right here? Now, we could ask ourselves the same question with, for example, the monthly fair value gap that we had a little bit earlier on. This monthly fair value gap, I know for a fact that a lot of people were eyeing this monthly fair value gap to trade back into it to then potentially continue higher from it. If your higher time frame bias is bullish, then what is the one thing that is arguably guaranteed, or at least close to guaranteed? Well, that we're going to be bullish, that we are going to be moving higher. So what is the one thing that's not guaranteed? Is retracements. It's not likely, or it's not guaranteed, that we are going to see retracements before we continue higher. This move is close to guaranteed, but the retracement, no, it isn't, because that's going against the higher time frame momentum, which is bullish at that moment in time. That's why you have a higher time frame bias of being bullish. So how do we then know if we are not going to see those retracements and if we are already going to continue higher? How can you not end up waiting forever until we do see you trade back into the fair value gap? Well, simple question. What is preventing us from continuing higher? And if that thing that is preventing us from continuing higher is not preventing us anymore, well, then we're allowed to move higher. So, for example, if we have this premium array, which is this fair value gap, the bearish fair value gap right there, if this fair value gap is getting disrespected, is not preventing us from continuing higher anymore, then that means we are again allowed and free to move towards the next premium array, which is this swing high right there. And that's again where I want to hammer this into your brain. This is where we trade in between PDAs. So in this second method, it is important to understand that a clear daily bias comes from the moment that we disrespect a PDA. Because the moment we disrespect a PDA, we are free to move towards the next PDA. So if we disrespect a premium array, in this case, this bearish fair value gap, then we are free to move towards the next premium array, which is that swing high right there. And now see how many times this happens. That is an area, this right here. So all these green boxes, they have that same thing in common. We disrespect one PDA, we are allowed and free to move towards the next PDA through trading in between the PDAs. So then the question really becomes, how do we know if we are respecting or disrespecting a PDA? Well, this can be done objectively as well. So I'm going to read to you the 2-candle rejection rules. 2-candle rejection tells you if we are respecting or disrespecting a PDA. And based on that, you can understand if we are free to move towards the next PDA, what are we doing? So 2-candle rejection is the following. If the first candle is a rejection, like we see, for example, with this fair value gap right here. To simplify the rejection a little bit, the rejection is that long wick that you're seeing right there. If the first candle is a rejection, that means the second candle, the third candle, the fourth candle can already continue higher. When this happens, this means we are respecting this bullish fair value gap at this moment in time. But it's called 2-candle rejection for a reason. Because if the first candle is not a rejection, like we see, for example, with this fair value gap. So the first candle doesn't have this long wick at the bottom. Then what can happen is the second candle sweeps the previous candle low right there to then create the rejection. So then the second candle is essentially going to be that rejection. So based on those 2 candle rejection rules, I'll put them here on the screen again. We can determine if the first candle or the second candle is the rejection high. So for example, we have this bearish fair value gap. So if we have this bearish fair value gap, we have the first candle right here. Well, we could argue, is the first candle a rejection? Again, it doesn't really matter if the first candle is a rejection. As long as this is still intact, then that means we are respecting the fair value gap or any PDA that we have at that moment in time. So for example, with this swing high, we are still respecting that swing high right there because 2 candle rejection is still intact. So whether the first candle is a rejection or not, the worst case scenario could be that the second candle is going to do something like this, sweep the previous candle high to then continue lower right there. But if we want to see this fair value gap be disrespected, and in order for us to move towards the next PDA right there, then we need to see price action run the rejection high. So we need to see a run of this rejection high right there. Again, second candle right there is also a rejection, perfectly fine. Then this is just waiting, right? This is just waiting. So what you've now done is you've also added a clear parameter to your trading. You know exactly what you're waiting for. So here you can also now place an alert right there above that line, above the rejection high. And once we start running the rejection high, we are disrespecting the fair value gap. So you know this right here is where I want to get involved towards the next swing high. So how do we know if we are running this swing high? Well, again, what is running? What is sweeping? When we are respecting a PDA. So a swing high is also a PDA, right? When we are respecting this PDA, that means 2 candle rejection is simply still intact. So it's still forming. So we could, for example, see the second candle be a rejection right here to still continue lower. If that happens, we are still respecting that swing high. So running that swing high is the same as disrespecting that swing high. And disrespecting this swing high right here is when 2 candle rejection is failing. So again, according to the 2 candle rejection rules, first candle is a rejection right there. So the second candle should do what? Should follow through lower right there. If that doesn't happen right here, and we get this new up candle, so we're not rejecting lower, then right now we can say that we are running, disrespecting this swing high, which was the rejection high from the fair value gap. So we are disrespecting the fair value gap. So you remove them from the chart. The moment we now do that, from this area towards the next PDA right there, that is where your daily bias is very clear, very obvious. But the next piece is about understanding time frame. So you'll notice I've been switching between the 1 hour time frame, the 4 hour time frame. When I refer to daily bias, I'm not aiming at just the daily time frame bias, if that makes sense. Because what you've just learned, you can apply this to any time frame. For example, on gold on the 4 hour time frame, if we start disrespecting this fair value gap, because that's the only thing that's preventing us from continuing higher, we have a clear path towards the next target right there. And we need to do that by starting to run this rejection high. This right here is where it's very clear to get involved. The same for this fair value gap right here. When we start running this rejection high, again, it's very clear we can target this next all-time high right there. But what about the daily time frame? Well, if we take a look at Australian dollar, US dollar, it's the same thing. We have this swing high. That swing high we see has 2 candle rejection initially sitting right here. So the second candle can follow through to continue lower potentially, right? According to the 2 candle rejection rules. But if we do the opposite and we disrespect this swing high right there, we are running it. And that means we can potentially start running towards this next target right here, which is what we see right here. With this next candle, we are disrespecting because the 2 candle rejection is not intact anymore. Now we can move higher towards the next targets. On the ES, the same thing right here can be applied on the weekly time frame, where for a very long period of time, it is very clear exactly where you should look to get involved. And to be precise, that is all these green areas right here. But what if you trade on the lower time frame? For example, the 1 minute time frame. Well, the same thing applies. You have this fair value gap, 15-minute bearish fair value gap right there. If we start running this rejection high, we're quite free to move towards the next fair value gap sitting right there. So once we start running this rejection high, again, you can even go into the 1 minute time frame and manage to get involved. Now you can take this a whole step further if you start applying 2 candle rejection to one time frame below the PDA. So this is a 50-minute fair value gap right there. If you now go into the 5 minute to start seeing the 2 candle rejection failing earlier, then you will have a really good idea that these 5 minute fair value gaps will actually hold, because the thing that is preventing us from continuing higher is already failing. I would say start off by simply mastering the same time frame understanding. And this whole trading thing becomes quite straightforward because all you're consistently waiting for is trading in between PD rays. And that trading in between PD rays, that is exactly what we call an area of opportunity in the MMT, where you are going to look to trade consistently, and you can do it consistently because you know what you're waiting for. And in the MMT, then we like to say that you have gained a piece of clarity. All right, perfect. Thank you.